morning, Chris. How you doing?
Good morning, sir. I'm good. How are you?
Excellent. This is Brian Jones. I'm here with professional trader Chris Hood, world's most interesting man, holding down the fort up there in Canada. How you doing?
I'm keeping everyone strong here, waiting for my vaccine. I think on current trend, it's going to be 2098. So I might die before I get the vaccine.
They're not prioritizing you guys up there in Canada, huh?
You know what? I was actually saying to my wife, can't we go and get vaccinated based on how we feel as opposed to how old we really are? Because my hips feel like 105. So, I should really be getting the first jab. But I don't know, man. They started jabbing a lot of people with the vaccine, and hopefully it's the sign of things to come. But, with politicians, I was laughing this morning.
Yeah.
You have the scientists who come out with the vaccine, say you need to take the second shot 4 weeks after you have the first shot. And the elected officials who've got no background in science are saying, no, we think 4 months would be better. Who would you trust?
It's all about logistics and not, science seems to take a back role in some of the political discussions.
Man, I'm glad I'm not a politician, because at the end of all of this, when we're all back to doing what we do best, everyone's going to be doing post-mortems on the decisions that these guys have taken.
Yeah.
And in hindsight, they're going to, but why didn't you do that? Why didn't you do that? Wwhy didn't you do that? And
it'll be interesting to see who the heroes and the villains are.
Oh yeah, absolutely. I see the Americans bombed up Syria again, so that was quite interesting. Like, after 4 years of not starting a war, you guys have,
whatever.
You reached your exhaustion and off you went. Like, look, I deserve it.
I have so little control over foreign policy. I didn't drop any bombs on Syria.
Well, that's the whole thing I've been trying to say, Brian. It's your fault. You got to do something.
Yeah. I'm sorry, Chris.
Do you realize how different the world would be if everyone did jiu-jitsu?
I know. They'd all have a jacked up nose, because I was grappling and, I got my nose smashed by, a good friend. It's whatever. It got split open, maybe broken. Who knows? Just thought I would spare everybody the giant cuts on my nose.
Oh, man. Well, I just wish I could get my nose smashed. I'm like, at least you have an opportunity to get it smashed, Brian.
Oh, well, you will get it. But we were talking, man, I'm kind of glad February is over. This was a rough, I came up ahead, not by much. I had some, the first week was really profitable. My second and third weeks, second week was profitable. Third and fourth weeks, I gave some back, but I'm still in the black for the month.
Here's the thing. We were talking about this back in November. All right. I think you'll remember back in November, I was saying to guys, look, November to January is pretty, it's not hard to make money. All right. It's a pretty easy time to make money statistically and historically. All right. Over the Christmas season. Right. We had always said, you've got to be really careful in February, because now this Christmas rally ends. Stocks that have been pumped up a little bit higher than most need to come back a little bit. And that's exactly what happened. There was a rotation out of tech, went into energy and finance. There are issues about that in itself in terms of sustainability. But long term, February is always a bad month, traditionally. March starts to develop this sort of choppiness, right? So the market starts to go up on Mondays, down on Tuesdays, Wednesday, Thursday rally, down on Friday. It's a statistical thing, right? So we can look back in history and we can see, this day normally is a bearish day. Some people say, look, you can't really do that because the market is just a collection of random people doing random things. So that sort of seasonal history has no bearing on that. That's fine, all right? But it gives us an idea of what moods are in there, what the sentiment is. So what I've been saying to all of my guys is, for March, you've got to be really, really careful, because you've got to hold on to what you've got. Okay, you've got to hold on to the gains that you've got. This is not a time to look back and say, geez, February kicked me in the nuts. I'm going to start revenge trading to try and make back, because you will get blindsided, particularly on Fridays. So what I said to my guys last night was, Monday, Tuesday, Wednesday, Thursday, you've got to try and exit positions before the expiry on the Friday. So if you've got any positions that are expiring on that week, you need to be out of them before the Friday, especially credit spreads. All right, because with the credit spread, you could be sitting on a Thursday at 70% profit. And you go, you know what, I'm going to hold it for one more day. I'm going to extract that extra 30% and I'm going to wait, let it expire 100%. Whack, the market takes you out on that Friday. You went from 70% profit to full loss. Not a clever idea. All right, so you have to make sure that you manage your account really well in March, so that with April is a traditionally bullish month. So with April, you want to still be, with a bit of gain that you've carried over from now January, the little bit in February, you kind of boost it up in April. May, June, July, you got to be a little bit careful, because now the summer months are coming, things start to slow down a little bit. The chop's still there. You're still going to see these chops, but you've got to be proactive. You can't just trade the same way that you did in November, December, and January in May, June, July.
So what do you do differently? I mean, as far as the setups and everything, or the trade types?
Well, the thing you've got to remember is stocks trade on 4 cycles, right? So we have an accelerating cycle, we have an accumulation, we have a decelerating, and we have a distribution cycle. So it looks like a frown, like a sad face. All right. So you go up, you go across, you go down, and so on. Now, the thing is, different strategies work better in different graphs. I'm going to pull one up, because I think Tesla is probably the most appropriate stock to actually look at. So Tesla on the day, I'm just getting it up here on my screen.
Tesla's the one that you hate to love, or you
oh my God, hate. Don't even bring it up. It's just a horrible stock. For me, it's just my worst. If you give me 1 second, I'm just getting it up here on my screen. I have a few things I need to just fix up here. Okay, there you go, ringing bells and everything. All right, so I'm just going to clean this up, because there's a little bit too much information here on the screen. And I'm going to just go out. There we go. Okay, right. Cool. So now if we look at, I'm going to share the screen. Where am I? There. Okay, here we go. Share the screen. Okay, so if we look at Tesla, if I take a zoomed out view, and okay, apologies for all the information that sits on this graph, but effectively what I want to try and show you is the sort of channel that you have here. So if we look, okay, that's better. This phase that you see here, this green candle going up here, when the stock is rising, all right, there's certain trade types that will work better in this market, but they won't work as well in that market, and they definitely do not work in that market, right? So a lot of I'll give you a scenario, right? So retail traders, often one of the first trade strategies they learn is a naked put, because the yield is very seductive, people like it, etc., right? So they go with naked puts. Now remember, with naked puts, your upside is limited. Your profit is 100% given to you when you start the transaction. And most people don't let these expire. Most people take a maybe 70 to 80% profit, and then they do another trade. They roll the trade. So they keep making the same profits, right? So as you're going up, you're making money. You're making money. You might have lost a little bit there if you are selling them at the money for the same week expiry, okay? So some people will sell forward. Some people sell maybe a couple days forward. Let's take away that technicality and just assume that they're just doing the same strategy over and over again. So in this rising market, because the stock is rising above the short strike of that put, these puts are devaluing really quickly, and these clients are making money. These traders are making money. So they keep selling the same thing over and over again, over and over again. They make money. Now, at this point, the strategy sort of falls apart. because the stock is not making higher highs. All right, so the stock is not going up here, it's going across. Now, naked puts work really well in neutral to bullish markets as long as you set your strikes right. So if your short strike is too close to the high and the stock is making lower highs, you run the risk of assignment and losing on that trade. So these people, they've made a lot of money coming up here. Let me see if I can get my little annotation tool. I've really enjoyed finding this. So they're making money over here. Market stalls. Stock starts to chop across. It's not making higher highs, but they're using the same strategy. So their win rate here might have been 7 out of 10. Now it's going to be maybe 4 out of 10. But the mentality of a novice is one of, I'm still correct. I'm going to carry on using the same strategy in this market. They haven't identified that the market has started to turn. Now they start to lose a little more. So now their win rate goes from 4 here. So they were winning 7 here. They were winning 4 here. Now they're winning 2. But they're still not convinced that the stock is going down. So they start doubling up. So now it's times by 2. They made, let's say, 10,000 on this side. They lost maybe 3 here. Now you've probably lost another 3. Your net gain is still 4 for the whole time from here to here. You've now only made 4. But you keep doing the same strategy. But now your losses start getting bigger. Now you lose 3. Now you're down to 1. Now you lose another 3, minus 2, and so on and so on. So this is what happens to a lot of people, is that they make money in the first phase, then they try to keep it in the second because they haven't realized the market has shifted. They lose a little bit. They still remain convinced that they know what they're doing, and then they lose the balance. So between here and here, they actually just lose everything, right? So they'll end up being square, 0. And this is the biggest challenge that retail investors have, is that their whole trading year is a sort of wave that goes from 0 to a little bit of profit to negative to 0, maybe a little bit of negative, then up to 0, a little bit of positive, and then back to 0. By the end of the year, they're flat. After all this work, all this effort, they would have been better off buying an index and doing nothing.
Right. So the brokers just made a bunch of money and they didn't.
Exactly. And this is, it's not because of the trades. And often when I talk to new clients and, you know, people who want to learn, I often say to them, I go, why didn't this work? And the first thing I look for is how they take accountability. And if someone turns to me and says, the market went against me, I don't want to teach them. Because it's not the market's fault. The market did not conspire to take money out of your pocket. The market did what the market did, which is random results. This is random, right? The problem was the trader had no knowledge or understanding of what he was doing in the first place. He was seduced by greed. And that seduction is what causes you to lose. It's not the fact that naked puts were the strategy. Naked puts worked fine. Everything worked fine here. It was the fact that he didn't want to increase the size of his toolbox to identify that that trade no longer worked, and he revenge traded over here. You know, the thing is, this drop from there to there blew up accounts. People physically blew up their accounts. The brokers do not care about that green candle, because when they phone you here and tell you to add cash to your account, you have a margin call. They do not care what happens in the future. They care about now. You have 3 days to put money in your account. So if you were selling naked puts up here with this strike and your broker phones you over here, you better put the money in your account. So the seasonality and the understanding and the identification of when a strategy is no longer appropriate for a stock is one of the biggest disadvantages for retail clients, because they cannot tell. They have no tools to tell them, because you can't work this out from a graph. It's really, really hard to look at a graph and say, yep, it's decelerating now, or it's distributing. because there's a lot of math that goes into determining whether or not the stock is actually in that stage. So one of the things that I try and encourage people to have is you've got to have a toolkit that allows you to convert your strategies as the stock starts to shift from stage to stage. So should your strategy move from stage to stage, and from, it should progress from being, a naked put on the one side to a bull put spread to an iron condor, maybe to a long collar, whatever trades that you've got in your toolkit, you have to know when to use them. So, February wasn't a surprise for a lot of people on our side. We knew that it was going to be a bad month. We prepared for it. We raised cash. We exited weak positions. And, the guys that didn't follow that sort of logic took a little bit of heat, and are probably still taking a little bit of heat, and it will take them a couple of weeks to sort of recover a little bit. So you've got to have that perspective with how trading works.
What kind of strategies work best in the choppy market of March in general, do you think?
So from my experience, selling iron condors in range bound markets, right? So you want to go to stocks that are going to stay in their box. And in choppy markets, you can often tell stocks have got these sort of peaks and they've got these troughs. And when you're selling condors that have the upper strikes outside of the peaks and your lower strikes outside of the bottom of the box, and you just want the stock to stay in the middle, you've got a high probability. Now, the thing is with iron condors is you've got to make sure that you're getting paid enough, number one. So, you've got to look for the premium. But two, you cannot be greedy when it comes to your profit targets. So your profit targets on an iron condor should not be the same as what they were on a naked put. On an iron condor, you go for 50%, 60%, and then you're out. You auto close these. You don't sit around and wait for expiry. The whipsaws that you'll see in March can often take a very profitable position and kill it in 24 hours. So when you've got the money on the table, you're out. You're done. It's gone. I also find that, selling spreads, put spreads greater than the one standard deviation move, particularly below the third Keltner, right? So if we were doing a put spread on Tesla, if we had Tesla sitting somewhere here, let's say we're in this position. This is the expected move over the next 4, 11, 18, and 25 days on Tesla to the downside. So if I was going to do a put spread on Tesla, I would be looking to go somewhere underneath the third Keltner, maybe even underneath the previous low. So I would have to be selling something around 620. And the hard thing is, at 620, you're not going to get a lot of premium. So you've got to be careful about how close you bring this up when it becomes a premium conversation. So you don't want to be selling it too close. I mean, this thing could easily swing. The squeeze indicator is still showing downward momentum. So this might just be a sort of, a head fake. We have to see a confirmation candle, right? So the way that we do it is I want to see 2 closes above the moving average before I'm convinced that this green bar is now cemented. So if I look at the daily chart, this is the daily. If I look at the hourly chart, let's see. So I've got my Elliott wave indicators in as well. I am firing long, but I've still got a bearish trend and I'm above the moving average. So I would be looking to do a bull put spread, maybe 670 somewhere here, 670 or 677 to 660. 670, 660, somewhere there could work. That would be a one standard deviation move. So you're looking at about a 68% probability of winning. I think those odds work fine, but be careful on timing. You don't want to be sitting too far out in time and then going through another one of these sort of, falling out of the bed kind of scenarios, because that would kill the trade.
So if you go back to that first chart, the daily. Yeah. I was just curious, are the predicted move indicators that you have there, are those, is that a script you've written or is that something that's in TOS?
No, this is a script. So this is just coming straight out of the option chain. So whatever the option chain is saying the expected move is, it just saves me having to go back and have a look and see and then calculate.
Gotcha.
It's just straight from the option chain. TOS as a system, it has a lot of faults. All right. There's a lot of faults around timing. I think though in the States, in the US, there are a couple of platforms that are as good. Let me just kill this. Sorry, 1 second. The one thing I really like about Canada is that they're very concerned about your ducts and cleaning your air ducts and also doing the weeds on your lawn. I love it. It's like a major thing. So the thing that you want to watch for in the US, right? The best platforms that I've seen, TradeStation is one. Tastyworks is pretty robust as well, and TOS. Those would be the three that I would put at the top end, particularly because of their analytical pieces. All right. So each one has got varying degrees of charting capability. You can script, you can write your own code fairly easily in TOS. It's not overly complicated. It can be at times, but it comes built in with a whole lot of indicators. So you can build your own set of rules around these indicators that you want to use. Tastyworks is also pretty good. Robinhood is good. I think you've just got to be careful about the sort of political thing around Robinhood. I mean, I'm not a client of theirs, but seeing how they behaved with the whole GameStop thing, I don't know.
They've had I had some money in Robinhood originally, and I took it out because of the crashes. I mean, they had like 3 or 4 major crashes during like high volume times. I didn't trust it.
Yeah, I think what they're going to probably they're going to IPO. I saw something that they were going to list Robinhood. I'm like, at the end of the day, I've been using TOS for the last 15 years or 10 years. I love the platform. I find it really user friendly. In Canada, it's a lot more expensive. So trading in Canada is 5 or 6 times more expensive than trading down in the US. So, it's probably the best platform in Canada on ability and application, but not on price. So at the end of the day, what I try and look at is, well, I don't mind paying more if my trading is going to be better. So right. I know I've traded on interactive brokers before, which was cheap as chips, but I had no analytical way of managing trades.
So you have to get subscriptions to a bunch of other services.
Yeah, and I like managing my positions all on one page, right? So I know if I've got a trade on, I know what my trade is, I know where my limits are, I know what my lines are. I can see it all in one screen. I don't need to go from screen to screen. I mean, I've got multiple algorithms here that actually do a lot of the screening and identification, but most of my analysis I do within TOS. And, I will build it so that I can just go to one screen and I can see exactly what trade I'm going to be doing for that stock. So I think the big thing for viewers is be careful of seasonality. Don't let seasonality push you out of the market. Treat seasonality as just another layer of information to guide what you're going to be doing and also to take away the surprise factor. Like, we said on Friday, there's a high likelihood that Monday is going to be a big day in the market. We knew that on Friday. And how did we know that on Friday? Because the indicators in the market, the internal indicators were telling us. So although Friday was a terrible day, Monday was being set up to be a great day because of the extreme readings we were getting on certain internal indicators. So you've got to try and get your trading and your mind to be not surprised. I'm not surprised today is slightly lower. Like, if we look at the futures, the market's going to open down. This day, historically, is a bearish day. Yesterday, historically, is a bullish day. They
So
both,
I didn't mean to cut you off. Where is there a good place to find out like the
seasonality?
Well, the historical performance on a given day.
You can, there's a thing called Stock Market Almanac. It's a website you can go to. There's a book. There's a guy that actually, the guy that runs it trades according to history. He actually trades based on the almanac. If the almanac is saying today's a good day, then he trades based on what the almanac is saying. I mean, there's a certain amount of there's an entertainment value to it as well. It's interesting to read, but you have to always remember the stock market is a collective of random people doing random things, and you cannot forecast randomness. It's really hard to work it out, but there's certain things that will give you an indication that tells you whether the likelihood, everything that we do in trading is about probabilities and likelihood, right? So if this, the probability of you having this outcome is this. That's
so
how
you
you
just
trade.
use that as another data source to
Yeah, it gives me what I use seasonality for is to understand the distribution of randomness over time. So if I know that this season, it's like, look at the summer. If you know the summer is traditionally hot, you're not going to take your clothes that are for winter and put them in your cupboard and lock away all your summer clothes. You're just prepared, right? So in March, or in February, for 19 years, February has been a shitty month for me. It's always been crap. I think I've always made money on trading, but my net liquidation value has always dropped in February. So the value of positions in February always drops down. So it's been like that for 19 years. There's no reason why I would actually look at it and go, well, this year is going to be different. You know how many people say, but this time it's different, right? This time it's different. It's not going to be different. It's going to be the same. And during the month, there were certain signals that were being given saying, what, this month is no different from the last 20 years.
And if it is super profitable, you're just happy. And if it's not, you're expecting it. So
yeah, and it takes away the emotional fear factor, right? This is the biggest problem for beginners, is that they only see the market as good or bad based on up or down. And I was saying to a couple of guys the other day is, if you describe the market as bad, it's based on your belief that up is good and down is bad, right? Because if you're saying the market's gone up, it's great, or the market's gone down, it's not so great, it's your belief that the market is only good when it goes up. I said to this guy, but what happens if you're shorting the market? Then if it goes up, it's bad, and if it goes down, it's good. And he was like a little confused. And I said to him, the only way to look at the market is not in vertical dimension. It's not up and down. You need to turn the graph on its side and look at it as extremes from left to right. Because once the market goes from far right, it's at the far right, and it's been at the far right for months, it has to come back to the middle, and then it's going to go back to the left. And when it's been at the left for extreme readings, it's going to come back to the middle and then go to the right. That way, the market's neither good nor bad. It's just left or right. And it's degrees of left and degrees of right. It takes away this expectation, because psychologically as traders, if you've gone long in the stock or long in a trade, you want the market to go up, but you have no control over that. And if you're sitting there thinking that the market owes you something because you are now playing the game, you're fooling yourself. The market doesn't conspire against any of us. In fact, doesn't even know we exist. We are so small, and we must stop thinking our opinion matters, because it doesn't. No one cares what we think. As a collective group of retail traders, maybe this GME thing is changing the perspective a little bit, that we can, collectively associate with each other and, wipe out a few hedge funds. The irony of it is those hedge funds have made all their money back already. They've done it. They don't go out and advertise how much money they've made. That's not, that wouldn't be in the spirit of, keeping them alive kind of thing. I think there'd be people outside their offices with pitchforks and torches, if they heard how much they made. So we've just got to get off this idea that says the world owes us something or the market owes us something for being there. No, we play by the market's rules, whatever those rules might be, and we choose to play. We're not forced to play. We've just got to know the rules by which we're going to be playing. So when we go into the market and we understand what's happening in the market, we can choose. If the market's playing a rough game today and, it's, sticking its finger in your ribs and it's, it's doing all those horrible moves from the old days,
Yeah.
You can decide to just tap out and go sit on the side and watch, or you can say, you know what, I'm going to play it back just as hard as you, and you can go in and play. But if you lose, you can't complain.
Right.
So that's the way I approach the market. I don't approach it in the sense of I have to do anything. You know, when a lot of people will come in and go, oh, I'm a trader, you know, they'll force themselves to find trades. Don't force anything. The market will give you what it's going to give you. And some days there are hundreds of trades, some days there's only 5, you know.
So if you don't find something that fits your criteria, it's fine to just not make a trade.
Yeah, most times. Like sometimes, you know, you'll find stocks that are meeting maybe 1 out of 8. You know, this is the thing. I have 8 rules. If it fits 8 rules, I've got the permission to do the trade. And I can do the trade at this size for this duration, etc. If it doesn't meet all of my rules, I can still do the trade, but I will go with a smaller trade or a less risky trade, or I will do something as a pilot. You know, let's just see where this goes. This trade could develop into something. Sometimes when you do trades like that, you miss the opportunity to add. So this is a big problem with my trade plan, is that sometimes I will go in too small on a trade, and before I know it, the position is up 100% and it's too late for me to add now. Or I'll go in with too big a position and it does nothing, you know, for a month. So finding that balance is what your job is. Your job is to find the balance that makes the money work for you. So if there's no trade, there's no trade. Yesterday was very, very quiet. Despite the market being up 700 points, there were just too many stocks trading towards the top end of the Keltners. You know, the stocks that I'm interested in. You know, I won't chase garbage, but you know, there were just too many that were overextended from the sell-off on Friday and the sell-off from last week. They
Yeah,
just
I think
bounced
I only placed like 1 trade. And
yesterday.
yeah.
Yeah.
And I put a couple of short calls on some things.
Yesterday wasn't a trader's market for a lot of stocks. It was a hard market to trade. Like in the morning, usually I can tell between 9:30 and 10:30 whether or not the day will actually give opportunities. And there was nothing. There were more opportunities on Thursday and Friday last week than there were yesterday.
So what do you see are some opportunities maybe for the upcoming week or so?
Let's have a look. So for us, the things that I'm looking at is, you know, what you've got to look at is where money is moving, right? So over the last couple of weeks, we've seen, I'm going to pull this up here from stock charts. It's a really interesting tool that if anyone wants to go and get it, it's available here at stock charts. If you use just the sectors and you go back to the beginning of the year, you know, there's the beginning of the year. And if you look at where money has moved from and where it's going towards, there's been a huge increase of capital moving in towards finance and energy. We've had only a little bit going into technology, and we've had a lot of money leaving utilities and consumer staples and stuff like that. So what you should be looking at is which are the industries and sectors that are getting money now. All right. So we know now that XLE and XLF as the 2 sectors, so finance and energy, are getting a lot of the money. So if we click on, we want to look at XLE and we want to know, well, which stocks are actually getting the money in energy. You know, you can't just go into energy and buy, you know, the biggest ones, Chevron or Exxon. Where is Exxon? It's somewhere up here. You can't just buy just because it's big. You know, there's been more money going into Marathon and Occidental and Fang. So we've got a trade on here with MPC. We've been trading this for some time. We actually went into this one in January. I think we're up. I think ours is risk-free already, but you've got to pick the strongest stock in the sectors that are moving. You can't just go into the sector and pick one. You've got to pick the one that's moving. So right now we did a trade on Devon that got us a lot of return. I think we made a couple 100% there. You know, there is some theory that goes behind the Laggards. You know, you could be looking to buy something in NOV or Varco as well as Conoco. You could do something down here with the intention that they have to catch up. All right. But you'd have to look at it, right? So if we took ConocoPhillips and we just put it in to a simple, you know, rules-based thing here, if I looked at the trade, I wouldn't be looking to do this trade because I don't have much of a squeeze. I have a short signal up here on overbought. So I'm really not keen to do this. It's trading a little too close to its third Keltner channel. So Conoco goes out, right? So we wouldn't look at that one. If we pick another one, let's see, let's pick Chevron, CVX. So you just go in and you would look at each one of these trades. Again, there's no edge to this trade because there's no squeeze forming, but overbought, and it's trading at the third Keltner channel. So you'd need a pullback. You'd have to wait for a pullback on these trades. If you look at one of the guys at the top, let's look at Marathon, MRO. Here again, you've got momentum decelerating here. It's turning down, trading at the third Keltner channel. I wouldn't be going into the sector. Like right now, it's telling me it's already had its move. It's already done what it was going to do. And if anything, it's going to pull back. So where would we go? Well, what you should be looking at is which are the industries that are going to improve. So you've got an improving industry here at XLV. So XLV is healthcare. There's been a little bit of a decline over the last 5 weeks. But if we change that in over the last 2 weeks, XLV hasn't had much money going in. Most of the money's been going into the energy sector. All right. So you can see that this thing is it's going sideways. XLF in finance sideways. Real estate is getting a bit of money. XLV estate still. XLC is moving up. Communication, right? So let's go and have a look at XLC. All right. So let's have a look. Our trade of the week was Twitter. So that was already in our file. We did a trade yesterday in LUMN. We did a bull put spread. So if we look at the trade for LUMN, here we have a squeeze starting to compress. It hasn't fired long yet. This is the daily chart. I would like to see this price above the ATR. So once this price is above the ATR and it starts going this way, all right, we just did a pilot type position here. I've got stacked EMAs. I'm positive here on the trade. I think that we've got enough bullish signals. My IV percentile is above 50, so I need to sell something. I can't be buying something here. So I'm going to be selling a put spread at this point. You can see the compression forming here. There's the squeeze indicated by the little red dot. So LUMN was the trade that we did. We've also got one on Twitter. I haven't done this one yet. I've been waiting for an entry price or an entry signal to come in. You see how close it is to this third Keltner? If you look at the hourly, what I'm looking for is for the stock to actually be a little lower in price. All right, so if I'm here, I'm looking for the trade to come a little bit down. I really just wanted to come down towards this blue, and then I can go in with a trade. So that's the way that you should be identifying stocks, is looking for the strongest sectors and then the strongest stocks within the sector, but analyzing the stock consistently the same way across the different criteria of your plan. All right, you can't judge this one stock by its MACD and then this one by its RSI and tell me which one is better. You have to look at both in the same way. The more consistent you can be in the application of a set bunch of criteria, the better your trading is going to be. So that's the way I do it, is I look for the strong sectors, I look for the strong stock, I then compare the stocks against each other. Which one's got the most potential? I always look at the setup, trade the setup. And that's the way that you can build your own process. You don't need sophisticated tools to do that. Here you have this relatively cheap tool from stock charts to do it on. And you can do this with each sector, right? If you're looking at some of the weaker ones, so you might have a strategy that says, you know what, I'm going to take positions in lagging sectors because at some point the rotation will come back to those sectors. So here you've got XLP. So we go to XLP. If this is your strategy, you would go to XLP to start building positions.
Do you like playing the individual stocks within the sectors more than the sector ETFs themselves, or?
Yeah, I do, because I think I can get a lot more out of my money if I do that. Sometimes the sector is actually easier to trade, from a liquidity perspective. Sometimes it's particularly around earnings.
Mhm.
I'll trade the ETF rather than the stock. I don't like earnings. I think it's a bit of a crapshoot. You don't know where it's going to go. You have all these companies that do really well and then they get nailed. It never makes sense to me. We beat all estimations, but let's cut 15% out of our cost, out of our price now.
Yeah, I was listening to some sort of a podcast about back testing earnings trades, and it's like we just decided to quit.
Yeah, no,
Like,
earnings
like
trades,
50 basically every time.
it's a 50-50, probably worse than 50-50. Because I think sentiment drives a lot. You could have, you had all these big companies. Amazon knocks the ball out of the park, loses money. Google, bang, best results, loses money.
So you like
How
to
do you
play the
trade?
anticipation run up, and rather than
You
and
can,
out.
yeah, that's a completely different thing. So trading it into earnings, so taking the run up into earnings, not every stock rallies into earnings. So you have to know what the stock statistical history is in terms of running into earnings, right? So I have some screeners that allow me to identify that stock, whether or not it's been running up to earnings, 75% of the time over the last 4 years, et cetera, et cetera. And then you can pick those ones because you've got a higher probability then of that stock continuing to do what it's always done. All right. It's that psychology of the stock. But yeah, you might want to be looking at building positions in this sector. You've got strong stocks in a weak sector. You could do this over time, but you've got to make sure that your expiration sort of cycle is a lot longer, because you're not going to be getting the industry to, or the sector to push the price up. You're still going to struggle with that, right? So here, could you buy, any one of these? You could probably look at Estee Lauder. Let's have a look at Estee Lauder and see if it says anything. I haven't looked at this, so this is new for me. Is this a trade? It's got a pullback here, close to the 8. There's a squeeze that's 5. There's no squeeze. There's just momentum. I've got a buy signal here. This could work. But you'd have to give yourself a lot of time. Problem here is your ADX is pretty low. Your beta, I prefer higher beta stocks, but I suppose I can't be a choosy person when you're doing it in a lagging sector. This could work. It could be an interesting trade. It's just that I don't know what the catalyst is going to be to push the price higher. And I would want to probably see a green candle, 2 green candles higher than that high. Somewhere here, I would want to see it trading a little bit higher, just to get rid of this red. Once I've got rid of the red and I'm moving that way, it could be interesting. But that's the way that you should look at it, is you can go to these sectors and then pick the strong stocks within the sector and then just compare them. Put them on a chart, put all the data down and see who weights the heaviest, who weights the best. And you go from there.
Good deal. Is that so? The as far as doing is that something you could do with that stock was the Estee Lauder, like is that one range bound? Is that sort of an iron condor?
No, this one for me, because you've got positive momentum here, the stock is probably going to move up. I just don't know where it's going to be. So if it's going to chop, I don't want it to be trading below that Keltner. Let's have a look at its daily. Let's see. So if you look carefully here, so, you sort of, as long as it doesn't drop below this ATR, I would probably be doing some form of Condor up at 310 on the call side and maybe 270, 275 on the put side for the next week or so. The thing is, you've got to look at the squeeze, right? So the squeeze has got no positive edge. There's no edge here. And this to me is my leading indicator. And because there's no edge, I would be a little reluctant to assume the price is going to go up. because there's no catalyst here. So I would probably do a put spread maybe for this week, somewhere down here, 272. What's the market price? 293. You're not going to get paid much, so you might have to go a little further out. Maybe you could do a 25-day put spread somewhere around 270, somewhere here, which is towards the second Keltner channel. First Keltner. That would have a 68% probability of winning. Yeah, that could work. But you'd have to make sure that you exit early. You're not going to hold this to expiry. But that's one way to play it. Now, put spreads work really well when your sector is moving up and the stock is moving up. All right, so those are the types of conditions that you'd be looking for. You don't want to just grab the stock and then say, okay, I'm going to do that. There's this sort of alignment between the various entities that will help.
Awesome. Well, Chris, I appreciate it.
Awesome stuff. Good to see you, man.
Yeah, we'll chat again next week, and you guys leave comments if you want us to discuss anything. Take care.
Look after your nose.
I will. I can't see it except on the screen, but I will.
Take it easy, man. Good to see you. I'll see you next Tuesday.
Absolutely. See you, Chris.
Cheers, brother. Bye.